Right, so stocks under pressure, traders cautious ahead of these talks between the US and China on trade set to begin tomorrow. Let's get more from Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Thank you very much indeed for joining us. I know one day it's very hard to read what investors are thinking, but do you think people are saying, well, or worrying that we're not going to get a deal in the near future between the US and China on trade?
Yes, and thanks again for having me. We've been studying the intraday movements like every other firm, and we've been looking at it from a little more of a traditional view. The whipsaw of developments in the trade policy here in the U.S. and of course with our partners globally is really it's difficult to pin down, and we haven't really cast a huge lot on being able to pin that down on an intraday basis. We feel like there's a lot of optimism coming into the weekend, of course, with our largest trading partner, and I think, in our opinion, the most this conversation between us and China really can tilt the scales one way or the other when it comes to inflation and also our economic growth from a real standpoint. So a lot is riding on this weekend. It's just really hard to peg, where things will turn out. We'll turn around on Monday morning. But the price, what the market is pricing in at 20 times earnings, is not a really pessimistic scenario. And we're trying to come to grips with what that means for not only U.S. equities, but also just risk assets in general.
That's interesting. I wanted to drill into that. So you think the market is not particularly cheap right now?
It's not by historical standards. 20 times is not necessarily the valuation you wake up in the morning and say that's where the market should be trading if a significant portion of economists and market participants are anticipating recessionary behavior, if not an outright recession, that we're either in right now or could be going into later on this year. That scenario of economic prediction doesn't really justify 20 times. So that disconnect, we feel like is a risk and an opportunity at the same time. The opportunity, of course, is that the economy does not go into a recession. Things turn out in a very positive manner, and that valuation is justified. Otherwise, earnings estimates have to come down, and that multiple is extremely vulnerable here at 20 times earnings.
You have some stock ideas for us. Delta. Now, we know that the U.S. airlines have been withdrawing, in some cases, their financial forecasts because of consumer worries over a trade war and the economic impact. But you see value in Delta stock.
Sure. Right now, we feel like especially considering the economic softness that seems to be, is predicted to be on the cusp of where we are economically. It pays to own the best of breed and best execution. And from where we see the airline industry and industrials being, kind of the epicenter of anxiety about trade negotiations and our trade policy going forward, Delta could be in a place to really, really catapult itself, especially from a valuation where it is now. It was traded very softly after April 2nd and then moving over the next couple of weeks. So it's attractive levels. It pays a dividend again. We feel like the clientele effect is positive for Delta. If the consumer doesn't go into a textbook recession where they lead spending in a downward cycle, we feel like Delta and other airlines could outperform going forward. But Delta is one we feel like has the best management team, execution. So that's where we'd be placing our bets right now.
JP Morgan, seen as the blue chip trade among U.S. banks. You see an opportunity here to buy those shares?
Yes, we own JP Morgan as well. So we buy us here. We look at the banks as a play on, perhaps a steepening in the yield curve if inflation is stickier than previously anticipated. And we still look to gradually get towards the Fed's 2% target. That stickier, steeper yield curve could continue to attract assets into this space. We've been there for some time now. And we're looking for JP Morgan, again, as an execution story. We want to own the best of breed in these softer, more uncertain times, even in the industry we feel like could have a leg up per its valuation. So that's why we prefer JP Morgan at this moment.
And let's put two retail ideas together here. Costco and Walmart. You think with consumers feeling shaky, these are decent names to own in staples?
On the surface, don't look like they belong together, right? How do you own Costco and Walmart in the same vein, considering, again, very uncertain path forward economically? But we look at Walmart like a hedge, if you will, as if inflation is stickier and perhaps could become more sticky because of trade policy, that would drive more consumers, as we saw in 2022 and 23, into Walmart's aisles, and they can, have more traffic and have bigger basket sizes. And so they're somewhat of a hedge against inflation in that inflation actually drives traffic to Walmart stores. Also, you have a little bit of a self-help story there as well, as the e-commerce business is really starting to gather steam at a time when some other retailers, their e-commerce business has tapered off a bit. Mm-hmm. Costco, they can change their SKUs a lot. Their model of changing SKUs on a very regular and almost dynamic basis gives them a benefit, as they have, of course, input costs as a lot of those products come from all over the world. Mm-hmm. That could change dramatically. They have the flexibility to bend when some of their providers bend as well. So we look at that as somewhat of a play on a flexibility around really dynamic trade policy as we kind of move forward through these negotiations.
Keith, thank you very much indeed for joining us.
Thank you.
Keith